Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. It's Quincy Krosby. This is The Talking Point. It's Tuesday morning. It is January 17th. This is a very busy week for the market, and thank you so much for joining me. First of all, we have Davos. This is the big confab that takes place in Switzerland. And all through the week, we're going to hear from many of the CEOs of companies, global leaders in terms of economies. This morning, for example, I was listening to the head of OPEC, he's come in, and he has talked about the OPEC statement that will come out later today regarding what they believe will be a need for oil in the this year. The one thing that he mentioned, he said, look, there are so many moving parts. We are looking at a potential slowdown in the U.S., slowdown in Europe in terms of demand if these economies slow down to the point that folks aren't driving, people lose their jobs and therefore they don't drive. He didn't mention that specifically, but that's what he meant. Or that, manufacturing slows down. In other words, the demand for oil drops. But he said at the same time, we are expecting China, despite the difficult opening or reopening, actually to pick up as we get into at least the second half of the year, and that demand is going to pick up from China. He even mentioned, by the way, that even with the COVID surge that they're experiencing now, they are already seeing a pickup in demand. Nothing compared with when the economy is going full throttle. But nonetheless, he said that is going to be important, as China begins to get through COVID and then start the process of rebuilding the economy. And he also was asked a question about the potential for more cuts in production. Keep in mind that when they cut production, it usually triggers the price moving higher. Anything in virtually any commodity is that when you cut production or there is no production, prices go up as demand picks up. So he was asked about that, and he went back to the rhetoric that they always use in OPEC Plus, and that is to say, we need to be able to balance the market. So he said, we still don't know how things are going to move, but what we expect is that Asia will pick up more as China picks up and as the West moves into more of a slowdown. So he said, pay attention to the report that comes out, but it will actually take a number of months to figure out where demand is actually going to fall. Because, as he said, central banks in the West are continuing to raise rates. We're actually hearing out of the European Central Bank, this is from Davos, by the way, that, maybe the European Central Bank needs to push financial conditions more into restrictive territory and perhaps, raise rates by perhaps 50 basis points at their next meeting. So it was extremely interesting because I know that everyone pays very close attention to where oil prices are going. And the question is, if they were to skyrocket, and that's a big if, it becomes inflationary. So this is important, and I want to mention, too, that many of the leaders from the World Bank and the International Monetary Fund are speaking as well. The head of the IMF, International Monetary Fund, mentioned this morning that their economists at the IMF expect the global economy to bottom by the end of 2023 and then begin to pick up as they come into 2024. It's something that I think most economists think that is exactly what's going to happen as central banks finish the rate hike cycle. And, that basically they feel it's comfortable enough to either remain on hold, but basically stop raising rates by the time we get towards the end of 2023. So keep in mind, there's going to be an awful lot of speaking. There's also going to be Fedspeak here in the U.S. with many of the Federal Reserve officials coming out with their ideas about what we should see happening with monetary policy here. I'm mentioning this because last week, the head of the Philadelphia Federal Reserve Bank made a comment that, wound up going, kind of in the internet, in many, many sites, because it was extremely interesting. He said, look, I see that we go to 25 basis points, maybe a second 25 basis points, or even, he said, that we actually pause, that the data on inflation continues to come down, and that we actually pause to see how things are. Now, remember, Chairman Powell has made it very clear they don't want to pause because they are afraid that, inflation, the sticky kind of inflation, wage inflation, for example, remains, and then it gets worse, and then they have to go and, raise rates even more. But I found it interesting that he came out and said that because, the fact is the Fed is saying that they're data dependent. When you're data dependent, it means that you are actually going to be watching the data, and you may raise rates, you may not raise rates. But right now, I just mentioned this again, the futures market does have a 25 basis point rate hike scheduled, or probability of one, for February 1st, and again for the one in March. So that is from last week. The other part of last week was the banks reporting on Friday. And these were the big money center banks. The one message that I took away was, just to give you an example, JP Morgan, that Jamie Dimon, not that long ago, had said that they were expecting an economic hurricane to hit the United States. Well, his weather report, so to speak, on our economy actually was dialed down. And he is in the camp that he expects that we will have the base case, a mild recession. That was echoed by Bank of America, although the CEO of Bank of America did say, nonetheless, even though they're expecting a mild recession, they are still adding more money towards the loan provisions, losses. The banks push money in, so that it's a safety net, so to speak, because when you do expect to see a downturn, when you expect to see a recession, you have to count on defaults, delinquencies, late payments, and so on. So I found that interesting, mild recession. And by the way, I think they were mentioned in some of the conversation was they expect it at the end of 2023, perhaps early 2024. The reason for the late analysis or probability is, remember, those rate hikes, we've had one after another. It takes approximately a year before they work their way into the greater economy, into the crevices. It's hard to imagine, but I'll tell you this, that when we start having rate cuts, the same thing is going to happen. We'll talk about that. The rate cuts don't really work their way into the economy for about 12 to 16 months. When we talk about the housing market, that's different because, as you know, mortgage rates are predicated on the 10-year Treasury. And so that moves accordingly. Speaking of, what we saw was when the mortgage rates came down, we saw refinancing pick up. And the reason I'm mentioning refinancing is that if you can go through the paperwork and so on, you have more money in your pocket at the end of each month, right? And that actually does help to continue spending, because we were always paying close attention to how the U.S. consumer spends. We did hear from the banks last week that more and more are using their credit cards, and that is something that does worry them, although they didn't say that right now. It's flashing red, that folks are paying late, payments, but that they are using the credit cards more and more. This week, speaking of the U.S. consumer, we will have retail sales. This will be extremely important because we did see retail sales pull back a bit. We want to see, though, are consumers, holding off completely? We don't think that's the case by any means, because we could see travel is picking up and people are going out to dinner and so on. We know that in terms of durable goods, those are the ones that last a long time. Refrigerators, even, I would even put sofas in that category. They last a long time. But we did that last year. We did that in the early part of 2022. And then as we came out of the pandemic, we moved into the services. So it's going to be interesting this week to see retail sales, also the producer price index, that's the PPI. Why is that important? Because that will be another indication of whether or not inflation in the process of manufacturing, for example, goes down and goes down in a meaningful way. It should. I say it should. I didn't say it's going to. I said it should. Because the supply chain is actually almost back to where it was before the pandemic. Not 100%, but almost. That would mean that the prices are coming back down to where they were, in a normal global trade environment. So the PPI, retail sales, and then we have a host of housing-related data releases, which will be interesting. We'll also have industrial production. But again, we're also going to have Fedspeak. And speaking of the Fed, we're going to have the Beige Book that's coming out at Wednesday at 2 o'clock Eastern. This is something that, believe it or not, it sounds so boring when we say beige, but that was the color when it used to come out in hard copy years and years ago. People didn't pay attention to it, but now they do, because it is a much more up-to-date, yet anecdotal report on the various regions in the Federal Reserve System. And they speak to business owners, small business owners, they speak to commercial banks, and they speak to CEOs. They give us a sense of how is the economy faring across the United States? What are the major concerns? What's the health of the economy? And that obviously is important in an environment where we're watching to see whether or not the economy is beginning a slowdown that is more than just a moderate slowdown. Speaking of that and the Beige Book comments, we will also, in terms of earnings this week, hear from regional banks. Just to give you an example, Truist, which is, a major presence in the South. We want to hear what they have to say about what they're seeing in the economy and in terms of loan growth, where that's coming from, and so on. We'll hear from KeyBank, very big in the Midwest and in upstate New York. We'll hear from PNC, and we'll hear from a couple of banks from the Florida or southern region, not just Florida. But these are extremely important because what they do is they complement what we've heard from the big money center banks on a regional basis. And needless to say, it's extremely important during periods like this. Now, no one is expecting that right away we're going to hear, red lights coming from them, but we'll see whether or not it's beginning to slow in a material way. That's what we're looking for. In other words, things getting less bad rather than good, right? So that's important this week. So we could put together a picture of the economy. Speaking of economies and less bad, China just came out with their numbers. They are just that, less bad. The market was expecting something more dire. Granted, these numbers come out of the Chinese government, but they are still the second weakest growth numbers since the 1970s. So China is, embarking on a plan to help bolster the economy, bolster consumer spending, by the way, they call it, private consumption. Also, again, according to what they're saying, is try to have the private sector become more engaged. The market is looking for China to come back into the global trade ecosystem, because the more they do, the more, according to many of the experts, then the supply chain is fixed completely. Obviously, China is a major component of the global supply chain. So when they come back, well, after the Lunar New Year, but we're looking at, again, probably the second, third quarter when they maybe, hopefully, get rid of COVID. Let me share something very interesting with you. I find this fascinating. Many of the Chinese are traveling for the Lunar New Year. They go home, in China, but many are leaving. And there are package tours where the Chinese leave China, and then they go to countries where they can receive, get this, Western vaccines with the Western technology, something they can't get in on mainland China. Fascinating, actually. But nonetheless, the expectations are they will have it under control by at least the second half of the year and get the economy growing again. I'm mentioning the global supply chain because you will hear more and more that there are concerns that as China comes back online, full time, that they are going to push up the prices for commodities, and then that will cause more inflation. Many of the experts who watch this say, look, in terms of commodities, the demand is not going to be larger than when China was building nonstop. Everything, infrastructure, housing, you name it, back in the early part of this century. And we didn't see inflation skyrocketing here. Yeah, inflation climbed higher, but it wasn't skyrocketing. Many of the economists who monitor this suggest that having them come back into the global supply chain will far outweigh the pressure that they put on commodities. So it's going to be interesting because obviously the demand for commodities is going to move higher because they want to move into, for example, electronic vehicles, right? That's a major area for them. Also to build their military and their military equipment, which, by the way, requires many of the commodities that are used in all sorts of production outside of military equipment. So there's a lot, forward-looking analysis. But nonetheless, right now for the U.S., the question is, do we see a continuation of inflation coming down? And this week, you will hear from the Producer Price Index, and that will give us another glimpse, another perspective of inflation. Besides the banks this week, we are going to hear from Netflix. By the way, they come in after the close, and it was always seemingly that if Netflix had a positive earnings report with positive guidance, it actually helped underpin the rest of the technology, the mega caps. Not so much anymore. So let's keep that in mind. If it happens, that would be very interesting. But that pattern was broken over the last session. So we'll hear from Netflix. We'll also again hear from the smaller banks. Another one that I'm going to be watching is Schlumberger. That is one of the big service companies for the energy sector. Halliburton has been rising. I didn't look this morning in the pre-market, but they have been doing well in terms of their earnings as a service provider in the energy sector. We will see if it follows through with Schlumberger, because many of the analysts are looking at the service sector as an important area within the energy complex. Now, one last thing as a PS, in terms of guidance, LPL research is looking at, how about a moderation in earnings as opposed to a complete collapse? There is a tug of war going on amongst analysts, some who are very well known, saying earnings are going to come down dramatically. Operating margins are going to come down so dramatically that the market could sell off about 20 to 23%. Then there are those who say not so fast. Companies have very smart managers in the United States. They will do what's necessary to have a solid earnings per share bottom line. But I do want to point out that as far as LPL research is concerned, right now we are not seeing that kind of on the other side of the tug of war, that dramatic downturn. We do see a bit of a downturn, obviously, because the economy will slow down, but not something that is so forceful and so dramatic that it causes the markets to just give us another major pullback. By the way, there's a report out from LPL Research today. It is the weekly market commentary. Please read it. That is what they are writing about. It's extremely interesting, and it has very important points that you can use for your clients. Thank you very much. Please don't hesitate to get in touch with me. I so appreciate when I do get a message from you, and questions, and even things where I can improve. I like that. I don't love it, but I like it, and I do try to follow accordingly. Take good care. Have a very good week, and thank you so much.
Prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.